Equity. Welcome, Aiman.
Hi, Jim. Good to see you again.
Good to see you. Just so you know, guys, Aiman has been with Schroders since 2017. So he's been responsible for a big part of the performance over the last 8 years. The fund that he manages has been around for 25 years. And Eamon has been in the industry since 2012. He is a BSc in accounting and finance and a master's in MSc in finance. So he's got plenty of qualifications and plenty of experience, and is managing a fund which has done exceptionally well for our portfolio since we've introduced it. So thank you, Eamon. And would you like to start off by telling us a little bit more about that performance over the last 10, 15, and 20 years?
Yeah, absolutely. Yeah, lots of letters by the name, which is always good for at least the parents to enjoy. But
Yeah.
I mean, if I just get this up on screen and hopefully you can see it pretty quickly. When you think about
Yes.
performance, I mean, the key point is, we work in a very competitive industry, and performance you can view in a couple of ways. Firstly, is how you're doing versus your benchmark, and secondly, how you're doing versus your peers. And this strategy is very much seen as a sleep soundly at night solution. And versus the benchmark, is exactly as you say, what we're really proud of is it's done exactly what it says in the tin. Over the last 25 years, I mean, a track record not very many managers have. That track record is plus 1% over the world index, which is exactly what the target is meant to be. Over the last 3 years, 5 years, 10 years, year to date as well, where it needs to be or comfortably above. The other part of that equation is how you're doing versus your peers, because of course you could have given your capital to another manager. And the reality is, as you can see on this screen, when you compare us versus our broad Morningstar peer group, so about 1,500 other active managers in this sample, the reality is we've done, again, a very good job for our clients. So there's not just top quartile performance, but in most cases, top decile performance net of fees versus other managers across that sort of 3, 5, 10, 15, 20, 25-year look back. So, performance profile we're very, very proud of. And it's good to be able to obviously speak to clients who are also happy with the job we're doing for them.
Hmm. Well, that's great news, and I suppose we could say to clients that that sort of gives you a little bit of a feeling of sleep at night whenever you're part of your money is invested in a fund that has been so consistent over such a long period of time. Um, Maybe if we get into that a little bit more, Eamon, what would you say has been the ups and downs of the fund? I mean, I know that yeah, and you've got that steady performance, but what has been the sort of highs or historical highs and lows that you could tell us little bit more about?
Yeah, again, absolutely. And I'm going to get some more evidence up on screen for everyone to enjoy. But
Lovely.
the it's interesting because obviously you mentioned how long I've been on the team when I joined, and in many ways it was a trial by fire because I joined at the start of 2017, and up until that point, the strategy had actually had almost no underperformance on a calendar year basis. I mean, where we sit today, outperforming in 20 of 25 calendar years is a great outcome. And in terms of that long run performance profile, which you see on the right hand side, you can see the beauty of that compounding effect of that plus 1% over the long term turns into a very, very strong cumulative outperformance. But on let's say, the more difficult time, I mean, you can see 2020 was a very hard year for the strategy in terms of how we performed versus the benchmark. And we underperformed by close to 4%. And at that time, we were speaking to clients and saying, the extreme underperformance is quite a clear representation of just how frothy markets have become and just how speculative they've become. And of course, that was COVID, lockdown orders, stay at home, profitless tech doing very, very well, lots of excess liquidity from 10 plus years of rock bottom interest rates. And it really came to fruition then. And it was underperformance that we were very, very comfortable weathering because we knew that it wouldn't last very long. And in 2021, you can see just that alpha was recaptured. So when we think about the world and we think about the long-term track record, we tend to group those 2 years together in terms of the rubber band expanding and then the rubber band snapping back and all that performance being recaptured. And actually, how we've performed since then is again something we're very, very happy with because we do market the strategy as an all-weather solution. We say we don't care about what style is winning or losing in any particular given market. We believe that we can outperform regardless of it. And 2021 value comes back to favor. 2022 market sell-off, value does better, but a lot of those big mega cap growth stocks in the US sell off. And then of course 2023 you had the market concentration in the Mag 7, and 2024 was a mixed year in terms of the Mag 7 performance, but it was very, very much a growth driven market. And then this year, you've had about four different markets over the course of 25. But the key point being, across all of those very disparate market backdrops, we've done exactly the job that we're meant to do. And it's one that hopefully we can continue doing going forward.
Yeah. Well, that is the sort of thing that we try to keep telling our clients, Aiman, that there will be down years. I mean, 2008 was a shocker.
Mm,
2018 wasn't great. 2020, as you say.
yeah.
But still, for those long-term investors who just held and didn't try to, do something different, they're basically well ahead of the game today. So I think we all get used to saying this is a long-term game that we're playing.
Yeah, that's exactly it. And
Um,
actually, whenever you talk about underperformance, exactly as you say, you expect there to be periods of underperformance. And I say, the only people who don't have any underperformance are probably, your Bernie Madoffs out there who are somehow defrauding clients. It's very natural for your style to be in and out of favor.
yeah, he only had one very large underperformance at the very end.
Yeah, yeah. And
Yeah,
it was a real shocker.
yeah, yeah. No, these are the type of returns that you guys are able to achieve. As I say, if clients are concerned about what the news might be today, we all know that we've lived through those types of periods before,
Mm.
and we will go through them again. But you're invested in some of the highest quality businesses in the world, which aren't going to disappear just because people's opinion about valuation might change over the next year or two. Okay, well, now let's ask a little bit about your style then. Eamon, what sort of style or sorry, before I get into that, let me ask you about the expected earnings coming out of different parts of the world in going forward, because for the last 10 years, we've had USA, USA, USA.
Mm.
Is that about to change, do you think?
It's interesting because when I was actually thinking about the USA
Yeah,
and how it performed after Liberation Day, it's
yeah,
that classic, is it Mark Twain quote, the rumors of my death have been greatly exaggerated. And we've seen exactly how
yeah.
the US has come back. But I mean, again, let me just share I mean, this is consensus estimates, so important to note that this, you can trust forecasts or you can't trust forecasts, but this is what the world or sort of the general analyst community is expecting. So this year, that earnings growth in the US to be significant and to outstrip, I mean, comfortably the majority of other regions outside of emerging markets, which is of course performing very well this year. And that earnings growth is coming through in those expectations. But the analyst community on the whole is expecting the rest of the world to catch up in the next couple of years, which, if it does come to fruition, is very, very positive for market breadth. And of course, broader participation tends to be a very good environment for systematic managers just because you can generate that alpha from a lot of different places as the rest of the world catches up. So hopefully a good backdrop for us. But, we are overweight the US in the strategy. We're underweight the rest of the developed world, and we do have an allocation to emerging markets. But from our perspective, when you talk about, and you mentioned it already, quality companies, those which are the strongest from a fundamental perspective, it's very hard to, at least at present time, look past the US. And of course, you can see that big purple bar on the left outstripping everything else. But when you look at things like what are consensus earnings expectations for US companies? How have growth companies outstripped growth in terms of the earnings side of things? Is the US actually more expensive today versus how expensive it was 5 years ago? And a lot of those questions, the answers are no. And so when you're talking about margin strength and cash flow generation and higher growth parts of the market, the US is still the area where you find more compelling opportunities. So yes, you have the concentration argument and the valuation argument, but from the quality side of things, and you can see it to an extent here, it is still quite hard to make an anti-US argument outside of the valuation and concentration piece.
Hmm. Yeah, it sort of brings to mind the thought that perhaps the USA is the last outpost of laissez-faire capitalism.
Mm. Well, I mean, what Europe's really good at is bureaucracy, and as we know, that's a
Yeah.
very stifling thing, which unfortunately we have been able to export somewhat, but the US has never been a big taker of it. So when you look at things like productivity and ease of doing business and that kind of thing, which obviously we're not going to incorporate into our process, but are things which allow a company to grow and set up, etc., more easily.
Hmm.
The US is miles ahead on being well, being far more business positive.
Yeah, and many of those large US companies earn more than 50% of their revenue from the rest of the world. So they're not just um, selling, doing business in the USA.
Yeah, and the same with sort of UK and European companies. I mean, often you
Mm.
people look at a European allocation or UK allocation, they say, "Oh, I don't want to get that country risk because France is on its fifth prime minister in 18 months, and the UK is a basket case as well." But you look through these big mega cap companies, and the reality is their revenue stream is genuinely diversified and it's not focused in the country that they're maybe headquartered or domiciled in. And so it's the regional allocations in the story are fine to an extent, but we need to remember that we are still, regardless of what's happened this year, very much in a globalized world.
Right. So now, to create this sort of track record over a 25-year period, you have to have an investment philosophy that sort of weathers all the storms. Would you like to explain what the philosophy is of this fund and what the sort of core mandate would be for your strategy here?
Yeah, absolutely. I'm always very happy to talk about our philosophy, Jim. And I mean,
Mm.
it's a process that's 25 years in the making, and it's interesting because I mean, when you use the word quantitative, which obviously QEP, quantitative equity products, sometimes you can lose an audience or lose a crowd because it feels like it's overly scientific. It's scientific, sorry. It's not based in an understanding of business models or economic rationale or what actually drives market. It's just sort of a statistical test that ultimately ends up in a portfolio. But what we do as a systematic team is very, very different. And in a way, it's actually a very traditional way of investing. So when you can see it in that first bullet point there, we see two key I suppose, fundamental measures as being the key determinants of long run alpha generation. And those are valuations and business quality. So buying good companies attractive from a fundamental perspective at the right price. And this matrix on the right hand side is essentially what we call our proof of concept or evidence of efficacy in terms of where do you want to invest, why, and to explain it very briefly, we take the output of our value framework, which looks at things like earnings, cash flows, shareholder yield, book, and we take the output of our quality framework, which looks at things like balance sheet risk and profitability and growth characteristics and stability and governance, etc. And we take the intersections of that output to assess over the long run, because to your point earlier, Jim, we are long run investors, to see how it performs versus the broader market. And in a
Mm.
simple basis, valuations in terms of those cheap stocks or the first column, that works over the long run. And quality stocks, i.e., that top row, that works over the long run. But the best performance is when you condition one on the other, i.e., quality with a preference on valuations and valuations with a preference on the higher quality. And that tends to be where the greatest long run alpha is, as well as the greatest probability of generating that alpha. And in terms of how we generate things, we think of the world in a fundamental way, in the same way as a fundamental analyst would, and we use our process for what it's really good at in terms of quantitative tools, and that's adding scale, applying that logic across a very broad universe so that we can, have diversification in our products, so we can find the most compelling opportunities wherever they exist in the world and allow us to build a very high conviction bottom up portfolio to the best
Yeah.
opportunities globally.
Well, Eamon, we're quickly running out of time, so perhaps we can now just go to your last slide, basically to explain for us portfolio construction, and that's where we will have to end it. So, but this is a very important point for our viewers.
Yeah, absolutely. And I'll try and talk quicker or say less. But the first stage would be that fundamental conviction. So any position that we hold in our portfolios are based on that fundamental story in terms of that combination and trade-off between value and quality. After that's done, we'll say, well, what else do we need to be aware of? What else matters as an investment manager and on the whole portfolio basis in terms of those additional risks and opportunities? And within here, we'd look at things like country risk or sustainability or thematic exposure or sentiment and momentum factors. And that will serve to essentially risk adjust a position size to capture all of those. And then the final stage of the process before we get to that sort of maximum minimum relative position size of plus minus 0.5% is when we call it market impact here, but you can think of it as what matters from a trading perspective. We are a big desk of over $35 billion of assets, and we want to make sure that all the products that we run are highly liquid, flexible, and cost effective to trade. And so we'll look at things like the cost to trade, the bid-ask spread, the daily liquidity ratios to make sure that the position sizes we build within our funds is tradable with minimal market impact and speed to trade. And so that comes in terms of the final assessment of position size.
Right. Well, Eamon, thank you. That's basically what we have time for today. So thank you very much for providing that explanation of your fund. And we can only say, on behalf of our clients, thank you for the contributions that the fund has made to our portfolios.
No, thanks very
Um,
much for having me, and well, hopefully we continue doing it for you.
Indeed. Thank you, Eamon. And thank you, financial fitness clients, for tuning into this Portfolio Partners, where you get to meet your fund managers. So thank you for tuning in, and we'll look forward to seeing you next time. Goodbye.